Hi everyone, and welcome to Chapter 12. In Chapter 12 we're going to talk about decentralization again. Decentralization, as we talked in an earlier chapter, of an organization is really pushing down your decision making and spreading it out through the organization to lower levels, getting everybody involved in decision making. The reason for that, or what that does, is it helps the top management concentrate on bigger issues, and lower level management make the day-to-day decisions. All right. To do that, or when you do decentralization, you set up centers, or cost centers, profit centers, and investment centers. A cost center is really controls over cost, not revenues or investment. So to give you an example of a cost center, if I'm an accounting firm in a large, or accounting department I should say, in a large entity like Target, I would be a cost center. I cost the company money, and I would be able to say how I can control those costs, but I wouldn't be able to make decisions on investments or revenues because I would have no control over those. A profit center, again with Target, would be each store. Each store could be considered a profit center because there's some controls over revenues and also cost. So a manager of a Target store would be a profit center. And lastly, an investment center would be really done by vice president of, say, development for Target. He or she would make decisions on where to place new stores and have control over investment of that building and the revenues and also the costs. So there's 3 different levels of setting up cost centers. If you do that, what you then want to do is have something called segment statements. A segment statement would be a statement that you would, an income statement or balance sheet, whatever it is that you deem necessary, that you would break out to those different segments, the cost center, the profit center, and the investment centers, and help them work on, you would give it to them so they could work on decision making for their centers. So again, the cost center person would probably just obtain cost of his or her department, like the accounting department in a target entity as a whole, and he or she would have control over those costs and would be deemed privy to that information so they could have ways of looking at those costs. A profit center, on the other hand, is like in the Target store. You would give the revenues and the expenses for that particular store to that manager of that store and have them look over that information, control it, and help determine how they can make their stores more profitable. And lastly, the investment center, you would give to the vice president of, say, development, the controls over the income statement, probably, statement of cash flows, balance sheet, everything that would help him or her determine if what he or she's deciding to do is going to make sense for the entity as a whole. So you would give them powers to look over all that information. Alright, and lastly, I'd like to talk about what's called a balanced scorecard. Balanced scorecard is an integrated set of performance measures that are derived from and supported by the company's strategy. What that means is a way of measuring the company's performances based off of, again, so to speak, standards and stuff that you help determine to help make that person manage their entity better. So a balanced scorecard is a tool that can be used in an entity to help lower level management and top management meet the goals of the entity. As always, I hope this helps, and I look forward to talking to you in the next chapter. Take care.